Welcome to The Explainer. Today, we're going to pull back the curtain on a powerful, invisible asset, something that separates the good companies from the truly great ones. It's this unseen force that lets some businesses just print money, while others seem to do nothing but burn through it.
Okay, so let's dive right in. And first, we've got to tackle a really common misunderstanding. You see, the word goodwill in the world of investing, it can mean two totally different things. And one of them is way, way more valuable than the other. To really get what I'm talking about, let's just start with a simple choice. Imagine you're an investor, and you have to pick one of these two businesses to own for the long haul. Yeah, it's a no-brainer, right? Of course you'd pick the money machine on the right every single time. But here's the really tricky part. On an accounting statement, these two can look almost identical, and that's the danger. It's way too easy to mistake a money pit for an invisible money machine. So that goodwill you usually see staring back at you from a balance sheet, that's what we call accounting goodwill. And all it really means is that one company bought another one and paid a huge premium for it. Honestly, far from being a good thing, it's often a big red flag that somebody just massively overpaid for a deal.
But here's where it gets really interesting. The greatest investors out there, think Warren Buffett, they're hunting for a completely different kind of goodwill. It's the kind you can't even see on a financial statement. It's the secret sauce behind the world's most incredible businesses. All right, so let's define this almost magical concept. This is what legendary investors call economic goodwill. It's the true engine humming away inside that money machine. And this analogy just illustrates it perfectly. A normal, everyday business, it's kind of like a pig. If you want more profit, you have to keep shoveling in more capital, more feed. But a business with strong economic goodwill, well, that's the golden goose. It just keeps laying those golden eggs, cash, without really needing much from you at all. So what does this superpower actually do? Well, it really shows up in two critical ways. First, the company gets the power to raise its prices without scaring away its customers. That's pricing power. And second, it gets the ability to grow profits without having to pour a ton of money back into new buildings or equipment. Let's make this super concrete. Picture this. Two noodle shops right across the street from each other. They both have the exact same tangible stuff. Kitchen equipment, tables, chairs, all worth $1 million. But Shop A makes a decent profit, $100,000 a year. Shop B, on the other hand, is cranking out a whopping $500,000. So what gives? Why the massive difference? It's not the pots and pans, that's for sure. It's something you can't see. Shop B's secret family recipe, its amazing brand name, the die-hard loyalty of its customers. That extra $400,000, that is the return on its economic goodwill. And you know what's cool? We can actually put a number on this invisible thing. Let's say a normal business should make about a 10% return. Well, on $1 million of assets, that's $100,000 in profit. The extra $400,000 that Shopee makes, that's its excess profit. And if we capitalize that at the same 10% rate, that invisible asset, the goodwill, is worth a staggering $4 million. Okay, so the noodle shop story is great, but let's see how this plays out in the real world with some big-name companies. I've got 3 classic examples of economic goodwill in action for you. First up, See's Candies. Their goodwill comes from just unshakable brand loyalty. You know, when Valentine's Day rolls around, you're not gonna risk showing up with some cheapo box of chocolates. No way. See's can jack up its prices, and to double its profit, it doesn't need a new factory. It just needs to print new price tags. Next, you've got a company like Moody's, the credit rating agency. Now, their business is basically a toll bridge for the financial world. If a big company wants to borrow money, it has to go to them and pay the toll. And here's the magic. The cost for Moody's to rate one more company is pretty much zero. They can grow like crazy without buying more stuff. And then, of course, you have a modern giant, Apple. Its goodwill isn't just about making cool phones, it's the whole ecosystem. I mean, once all our photos are in iCloud and we're used to iMessage and AirDrop, the thought of switching to something else is just painful. Apple owns our mindshare, and that lets them rake in cash from services year after year. Okay, so hearing about See's and Apple is awesome, but how do you actually find these companies for yourself, right? Well, there are a few key numbers you can look for that can point you in the right direction. First up is something called Return on Invested Capital, or ROIC. You want to see this number consistently above 15%.
Why? Because it's a huge sign that the company is an incredibly efficient profit generator and doesn't have to keep plowing tons of cash back in just to stay afloat. Next, you want to look at the gross margin. If you see a company with a nice stable margin that's hanging out above 40%, that's a really good clue. It suggests they have serious pricing power, so they aren't getting crushed every time the cost of their materials goes up. And the last piece of the puzzle, look for low capital expenditures, or CAPEX for short. If a company only has to spend, say, less than 20% of its profits just to maintain its operations, well, that leaves a giant pile of free cash for things investors love, like dividends and buybacks. All right, so we know what it is. We know how to spot it. But now we get to the most important part of all. Seriously, why is this whole economic goodwill thing an investor's absolute greatest shield? It all comes down to one big, scary word: inflation. It's the ultimate test for any business. During times of rising prices, some companies get totally wrecked, while others actually thrive. And the difference? It's economic goodwill. For these special companies, their brand is literally like having their own private printing press. Just look at this. You've got a capital-guzzling business, like an airline. Inflation hits, and boom, the cost to replace a plane doubles. They have to pour in twice the cash just to stand still. But then you have a company like Coca-Cola. Inflation hits, what do? They just raise the price of a can of Coke. Their money machine just keeps humming along. No new capital needed. But, and this is a huge but, we have to end with a really important warning. This amazing asset, it is not guaranteed forever. I mean, just think about Nokia. They used to completely dominate the mobile phone world. Or Kodak, who literally owned photography. One big technological shift can vaporize decades of goodwill almost overnight. And that, right there, leaves us with a big, provocative question to chew on. It's a powerful reminder that being a great investor isn't just about finding today's money machines. It's about thinking really, really hard about which ones will still be humming along tomorrow.